Hi, this is James Shrug with Westpac London's end of day report, and in fact the first one for 2013 for Friday, January the 4th. The markets in Europe were a little bit negative at the open, catching up to the negative sentiment engendered by the Federal Reserve's minutes to their December meeting, which revealed, not so surprisingly, that there was a split of opinion about the prospects for further quantitative easing, and indeed for how long the QE that's already been put in place might last, with some members arguing that it might need to be pulled back before the end of this year. Now, markets took that with a little bit of disappointment, and European markets initially were down because of that. But then the day's data started to kick in. It included UK services PMI, which fell from 50.2 to 48.9 in December. That's its weakest since the closing quarters of the recession in 2009. We had German retail sales volumes rising 1.2% in November, but that's just reversed a fall in October. The figures there were heavily revised. The European composite PMI for factories and services was revised slightly lower from 47.3 to 47.2 in December, still consistent with a contraction in economic output in the fourth quarter. Then we came on to the US data flow, which included a 155,000 increase in non-farm payrolls in December, a little bit stronger than the market was expecting. Revisions added another 14,000, and in fact in the quarter, the fourth quarter, payrolls growth averaged 151,000 per month, just down a bit from 168,000 in the third quarter, but up from 67,000 in the second quarter. The detail was mixed. Hours worked strong, hourly earnings healthy, points to strong incomes growth in December, but the unemployment rate rose by almost 1%, by almost 0.1%, from 7.753 to 7.849%. But after rounding, it's still steady at 7.8%, despite that significant 0.1 rise. Most job sectors recorded gains, with the exception of retail jobs, down 11,000 after 150-odd thousand jobs in the previous 4 months. IT and temping jobs were down as well, and government jobs as well. Decent gains, though, in construction post Sandy, and factory jobs were stronger too. That was followed by the US's ISM non-manufacturing index, which rose from 54.7 to 56.1 in December. That was higher than any forecast, its highest since February, and reflected a slightly lower business activity, slightly stronger orders, but a decent jump in the jobs component. Factory goods orders reported flat in the month of November. We already had the durables component, it was up a bit, non-durables were down. So that was the main data news. What it did for equity markets was really not that much. I mean, it helped bring, the data helped bring markets back into flat, slightly positive territory, but only marginally so. In the case of the US, the Dow is up 0.07% at the time I'm speaking, which is 3:30 in the London afternoon. Europe hasn't closed yet, but the FTSE is up 0.6%. The French market up 0.25%, and the Germans up 0.25%. The Spanish market's up 0.5%, and the Italian market up 0.25% today. On commodity markets, there were quite steep losses earlier on, but they've abated somewhat since the stronger US data. For example, gold is now down 1.5% at $1,648 an ounce. Oil is down 0.05%, basically flat, at $92.87 a barrel. It was down 1% earlier today. Copper prices are down 0.6% at 369 cents a pound. The Aussie dollar has had a bit of a seesaw ride too. It was in the midnight London time, so what's that, 16 hours or so ago, it was trading at 1.047. Just before 12 o'clock this afternoon, it was trading at 1.0395. It's back up at 1.046 at the moment, with the morning session's Aussie dollar weakness reflecting the Fed minutes largely, maybe a bit of ongoing disappointment about the fiscal policy lack of decision making in the US. But the more recent upswing in the Aussie in the last few hours has reflected that stronger US jobs and ISM non-manufacturing data. That's about it really for today, for the first report of the year. I'll be back next week. Look forward to speaking to you then.